Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about T-Mobile US Inc. quarterly report. T-Mobile US Inc. offers a wide range of services and products to its customers. Some of the key businesses and services provided by the company include wireless communications services, voice, messaging, and data services for postpaid, prepaid, and wholesale customers, sales of wireless devices, including plus smartphones, plus wearables, plus tablets, plus home broadband routers, plus other mobile communication devices, accessories for wireless devices, financing through equipment installment plans, reinsurance for device insurance policies, and extended warranty contracts. High-speed internet services. The company operates under several brands, including T-Mobile, Metro by T-Mobile, and Mint Mobile, and offers its products and services through various channels, such as retail stores, customer care channels, national retailers, and online platforms. The T-Mobile US Inc. TMUS stock price has experienced notable fluctuations over the past year, contrary to initial expectations of making no significant changes. Despite this, several key events have shaped the company's performance. Strong earnings and subscriber growth, including 830,000 postpaid phone additions in the last quarter, have highlighted T-Mobile's successful execution of its 5G leadership strategy. The company has also increased shareholder returns with a 16% dividend increase and launched new business connectivity solutions. However, these developments do not fully explain the stock's significant movements over the past year. A closer look reveals that the stock reached an all-time high closing price of $270.87 in March 2025, but experienced a 23% pullback from its peak. The 52-week low was $208.39, indicating that the stock did indeed see changes, exceeding the -4.9% threshold. The main cause of T-Mobile's stock price fluctuations over the past year can be attributed to market volatility and investor sentiment. Analysts maintained a hold rating for TMUS with a consensus price target of approximately $253, suggesting moderate upside. Additionally, increased promotional activities from competitors like AT&T and Verizon may have contributed to the stock's pullback. Overall, while T-Mobile has made significant advancements in its business, the stock's performance is influenced by broader market factors. The primary drivers of revenue growth or decline for the company can be summarized as follows. Revenue growth is primarily driven by an increase in postpaid revenues, equipment revenues, and other revenues. The acquisition of UCellular also contributed significantly to revenue growth, with a purchase price of $4.4 billion. Additionally, investments in Metronet joint venture, $4.6 billion, and Lumos joint venture, $932 million, have led to an increase in fiber customers, further driving revenue growth. On the other hand, revenue decline is primarily driven by a decline in prepaid revenues due to lower prepaid net customer additions and higher churn in postpaid phone customers. The sale of spectrum licenses also resulted in a significant revenue decline of $2.809 billion. Furthermore, the inability to attract additional equity financing outside the United States has limited the company's ability to grow its revenue. Net income and profit margins. A mixed picture. The financial performance of a company has been marked by fluctuations in net income and profit margins. For the 3 months ended September 30, 2025, net income decreased by $345 million, while for the 9 months ended, it increased by $531 million. However, when looking at specific periods, there was a decrease of $266 million, 6%, for the 3 months, and an increase of $1.1 billion, 8%, for the 9 months. Profit margins have also seen changes. The net income margin decreased from 15.2% to 12.3% in the 3 months ended September 30, 2025, but increased from 14.1% to 13.9% in the 9 months ended. Core adjusted EBITDA margin saw a decrease, although no specific percentage was mentioned. These changes suggest that the company's financial performance is not consistent across different periods and metrics. While there are increases in net income for certain periods, decreases in profit margins indicate areas of concern that need to be addressed. The company is indeed generating positive operating cash flow. According to the financial summary, the net increase in operating cash flow for the 3 months ended September 30, 2025 was $1.3 billion, 21%, and for the 9 months ended was $4.6 billion, 27%. This significant increase indicates a strong financial performance by the company, demonstrating its ability to generate positive cash flow from operations. The company's debt level and interest expenses have undergone significant changes. Long-term debt has increased substantially, rising by over $3.6 billion to reach $77.9 billion as of September 30, 2025. This increase is evident across multiple pages, with a notable jump from $72.7 billion to $76.4 billion on page 3, and another rise to $1.629 billion on page 34. Conversely, short-term debt has decreased by $206 million. Interest expenses have also seen a significant surge, with net interest expense for the 3 months ended September 30, 2025, reaching $924 million, an increase of $88 million from the previous year. For the 9 months ended September 30, 2025, interest payments, net of amounts capitalized, rose to $2.923 billion, up from $2.778 billion in 2024. These changes indicate a notable shift in the company's financial landscape. Management is optimistic about the company's outlook, citing several key strategies to drive growth and expansion. The main focus areas include increasing competition in the U.S. wireless and broadband industries by enhancing rural 5G coverage and retaining ownership of spectrum licenses and towers. Additionally, management plans to achieve synergies from acquisitions, such as expanding offerings through deals like Blythe and Lumos, and growing service revenues from operations. To support these initiatives, the company will issue debt to settle exchange offers and enter into a master license agreement to lease space on retained towers. Management also prioritizes general corporate purposes, including capital expenditures, spectrum purchases, and share repurchases. Furthermore, they plan to continue building out their nationwide 5G network and digital transformation efforts in 2025. Overall, management's strategy is centered around driving growth through a combination of organic expansion and strategic acquisitions, while maintaining a strong financial position to support these initiatives. The company has made significant moves in its financial landscape through acquisitions and divestitures. Notably, it acquired Lumos, a fiber-to-the-home platform, through a joint venture with EQT Fund VI. Additionally, the Sprint merger was completed on April 1, 2025. On the other hand, SoftBank ceased to be an affiliate on August 6, 2025, marking a notable divestiture. The company has demonstrated its commitment to returning value to shareholders through 2 key initiatives: dividend payments and share buybacks. Over the 9 months ended September 30, 2025, the company paid out a total of $3 billion in cash dividends, providing a direct return on investment for shareholders. Additionally, it repurchased $7.5 billion worth of shares during the same period, reducing the outstanding share count and enhancing shareholder value. Concerns about inventory buildup and supply chain disruption are valid. The financial summary highlights potential issues with inventory buildup and supply chain disruption. Several factors contribute to these concerns, including economic, political, and market conditions, page 73. Specific risks include operational delays and higher procurement costs due to trade policy changes, as well as supply disruptions or cost pass-throughs from suppliers struggling to absorb increased costs. Additionally, sourcing critical equipment may be delayed due to customs clearance and supply chain bottlenecks. This pressure on expenses and customer pricing can result from material changes to cost structures. These risks underscore the need for careful management of inventory levels and supply chains to mitigate potential disruptions. That concludes the financial summary for T-Mobile US Inc. Feel free to comment below, and I will be happy to answer them when possible.